What's going on, team? I hope you're all having a great time. In today's video I want to talk about the basics of market structure and technical analysis. Well, structure in trading is where you draw lines on the chart that shows you where the price is usually bouncing around. And technical analysis, it is the use of market history and common patterns in market data to identify trends and make predictions about what price is likely to do in the future. Technical analysis, the use of market history. Market history is a collection of data of the price of something over a period of time. For example, the history of the price of gold from 1998 until 2020. On the bottom you can see the time, and on the right you see the price. It is a clear uptrend. If we take a look at the price history over the last 5 years, it looks like that. It is still an uptrend. The price movement of the last 12 months looks like that. Now let us take a look at the price movement on a daily candlestick chart. Now let us mark the areas where the price likes to bounce on the daily chart. As you can see, price likes to bounce at these zones. The next step is to zoom in on the 4-hour candlestick chart to get a better overview and maybe add a few more levels where price likes to reverse on the smaller time frame. The reason why price continues to react in certain price areas is because of what has historically happened in the market. It is very easy to spot where price likes to reverse. Whenever price meets a previous price, more people or institutions like to buy or sell at that previous price because it is the best price that the market has achieved in the past. So the first thing we need to do is to identify the price levels where price usually bounces to make our prediction for the future. And technical analysis is the use of market history and common patterns in market data to identify trends and make predictions about what price is likely to do in the future, as I said before. So the next thing I want to talk about are horizontal price levels. You can call it support and resistance as well. Support is when the price bounces upwards. Check the blue boxes in this example. And resistance is when the price bounces downwards. Check the red boxes. When price clearly breaks a significant resistance level, it typically starts to interact on that previous resistance, and typically price will bounce upward because of our rule of thumb is that old resistance becomes the new support level when price has broken the level clearly. On the other side, when a significant support level gets broken, it typically becomes resistance in the future. It doesn't mean that this happens 100% of the time, but it happens most of the time, which helps us to identify what price might do in the future. And this is how we basically make money. We dive deeper into this topic in another lesson. The next thing I want to talk about are diagonal price levels. You can call them trends as well. I'm talking about uptrends and downtrends. If the price is going up, we call it an uptrend. If the price is going down, we call it a downtrend, as you all know. And if we analyze the chart, we want to identify the very clear horizontal price levels as well as the very clear diagonal price levels. And the idea is that price tends to bounce around at these levels. Nothing is guaranteed, and price sometimes does not respect these levels perfectly, but if we analyze the higher time frames like the daily chart or the 4-hour chart, then we can make very accurate predictions of price movement, which allows us to make consistent profits. And if the price clearly breaks a diagonal level, it tends to create a new trend. This is what price does all the time. It moves from an uptrend to a downtrend to uptrend to a downtrend and so on. And all we do is we draw all the clear horizontal and diagonal levels, as we know that price tends to bounce at these levels, to predict the future movement of the market and get good entries. We focus on the daily and 4-hour chart for our analysis because it is the most accurate time frame based on my experience. On the daily chart, each candle represents 1 day of price movement, and on the 4-hour chart, each candle represents 4 hours of price movement, as you all know. And Whenever you make your analysis, you simply just go into the daily and 4-hour chart only. All you do is find the areas where price has just interacted or bounced within the past. You can draw lines or you can draw boxes to mark up the horizontal areas of support and resistance. I like to use boxes more often because price sometimes does not respect the price level 100% perfectly. You will see that price sometimes moves just above and below the levels, and that's why I like to draw boxes to mark up the horizontal levels. So I have these zones. And very important to understand is that we don't want to sell in an uptrend and we don't want to buy in a downtrend. It is very important to understand what the overall trend direction is. A downtrend forms lower lows and lower highs. That means whenever price bounces away clearly, that's a low. And then other areas where price falls away and reverses that to the downside like a resistance, we call those highs. You can clearly see the characteristics of a downtrend with lower lows and lower highs. As soon as we see that price is forming higher low and higher highs, we talk about an uptrend. And this is how it looks like on the 4-hour chart. All we want to focus on is to wait for a clear break of a significant level and then get in on the retest in the overall trend direction. If we are in an uptrend, we buy on the retest. If we are in a downtrend, we sell on the retest. And this is how we basically do it. I'm going to dive deeper into this topic in another lesson because we have to talk about entry confirmations as well. So that's it for now. Thank you for your time. See you in the next video. Peace.